It was only a couple of weeks ago where we talked about the possibilities for a massive bull trap to be forming. Well, the S&P 500 did break to new all-time highs and then reverted. There was various signal charts, divergences, and levels from a very important standpoint that we discussed on that episode, and it ended up playing to the downside. On today's video, I'm going to talk about the flip side and how to potentially look for a bear trap, because as price action continues to decline and fall, narratives get louder, and sentiment shifts dramatically as well. So we're going to be discussing various signal charts on today's stock market brief show and give you a good sense of what to look for if this is actually a bear trap versus the possibility for a dead cat bounce. All that and more on today's stock market brief show. Make sure to sub to the channel if you haven't done so already. I'm partnered here with Interactive Brokers. If you haven't checked them out, please go to the description or the link, click, take a look at them, take a look at their Interactive Broker Campus, a bunch of free resources there, including finance courses, tech courses, beginner to advanced. And also a big shout out to all my patrons and all the new patrons that have been coming in. $9 a month really does support many things that I do here on this channel for free and a lot of the free content. And then I give as much as I can over here for that $9 a month. If you want to save 16%, which ends up being only $7 a month, by the year it's $9. Let's get into today's show. All right, everybody, welcome back. This is a chart of the S&P 500, the SPX on the daily time frame. And yes, we saw a massive move today in terms of volatility. In the S&P 500, it was down 1.6%. We started with a gap up and it was faded. If we take a look at the 11 sectors that make up the S&P 500, tech definitely led the way to the downside. We still saw some green on the board. So by all means, this was not a full-blown capitulation by any sense. You see consumer cyclical, tech, Nvidia, Google, Meta, Netflix. What are you noticing here? It's the bigger market cap names that started to see more air kind of out of that bubble. Now, this to me, once again, is not a capitulatory type move because we're not seeing all red across the screen. We'll talk about that in a little bit more, but this is more of like a 50-50 sort of advanced decline. Now, this chart has been flying around the internet, more specifically, not this chart, but the AAI Bear and Bull survey, which really helps us determine sentiment. And the sentiment can be used as a contrary indicator. And the one that people have been talking about is the bear side over here. So we're getting a very, very bearish reading. And the common thing that I'm hearing amongst everybody that's posting this is, how are we this bearish, but we're only about 4.5% from all-time highs? And that is what I want to quickly discuss and could be a potential another contrary indicator that can lead to a bear trap. Now, how dramatic of a reading actually is this? Because I'm only showing you 1, 2, 3, 4, 5 years. And it's the lowest reading here in 5 years, or one of the lowest readings here in 5 years. So if I zoom out and look at the history of the AAI Bear Bull survey, below us is the bear. It's showing a negative reading, by the way. That's just because how I have my chart set up. So it's giving us a 60.6 reading as of right now. The bulls on the flip side, I just have this one inverted. So it's not like negative 60. It's just how it's set up. But continuing on, I drew a line as to where we were, and I look back through history. I'm like, wow, we've only actually seen this level 1, 2, maybe 3 right there, actually, 4, 5 or 6 times. So 1, 2, 3, 4, 5, 6, 6 times throughout history of this survey have we actually seen this levels. This is dating back to the 90s. I think it goes back a tad bit further, but to make the chart look like this, I didn't use that data because it wasn't an extravagant reading. Now, what do you notice here? The S&P 500 is up here, and when we get these readings, it's coming from pretty much bottom. So here was the 1990s, early 90s, a big sell-off over here. Potentially that was the 87 crash, what I'm looking at. I can't quite get the exact date on it. This is the financial crisis over here, and this was the bottom of the 2022 bear market. And then what's the difference? Well, we're like right here, and these things have been sinking to get these type of readings. So what the heck is going on? Well, one thing that we can look at, amongst other things, we can talk about Fed policy uncertainty. We can talk about inflation concerns. We can talk about potential economic slowdowns. We can talk about market concentration. We can talk about all different types of stuff. One thing that I can call out via a chart and kind of give you an idea why there's so much fear is something like this. This is equal weight S&P 500, and trust me, I'll dig more into this. S&P 500 down here. And what did you notice? Well, we didn't make new highs. The S&P 500 did. Okay, so it's basically telling us that we have weak breadth. But how weak is this breadth? Well, if you go over to FinViz, which is a free tool for scanning, you can go into the industry during the screener and you could say, I only want to look at stocks. And then I only want to look at small caps plus. So anything over a small cap, I don't need to look at the micros. We can do that in a second. But if we look at everything that's a small cap stock and higher, they scan for about 3,300 total stocks. Okay, that's how much is in their database that they look over, which gives us a very broad view of the market. So what happens here if I put a 52-week high-low reading and say I'm only looking for stocks that are 20% or more below the 52-week high? Take a look. You then get a total amount of stocks. It goes from 32 or 3,300 down to about 1,700. So what's the quick backhand math here? It's telling us that over all those stocks, over 50% of those stocks are in quote unquote bear market territory. All right. Over half the stocks are below 20% from their 52-week highs. So you're seeing what I interpret this from this is you are seeing on a large scale here, many stocks have been getting absolutely crushed. And you can, if you want to do this yourself, go to FinViz, type in 30% or more. You'll have less stocks here, but it's still a large percentage of stocks that are getting absolutely hammered. So let's just take a look at the industry. We'll do only stocks. I don't need the other stuff, just stocks only. How much do they look at if we look at all their stocks? Well, they scan for about 5,500 in total. And then we look at all the stocks, 20% or more below. How many are there? 3,500 that are available. So 64% of the stocks are below their 52-week highs. Pretty impressive stuff. Does that make sense? We're looking for any stock within this list that's 20% or more below the highs. So what percentage of this is this? That's 65%. That's a huge number, and that's what we're seeing. And guess what? You have the ES. It's starting to slip off. We're starting to see more volatility. This is the range. In yesterday's video, we talked how it was kind of flirting with disaster. And well, we flipped and we kind of just cracked down to the lower part of the range. So now we're in a very precarious spot here that can have the potential to create a bear trap where it comes in, people get freaked out, and then we rip up higher. The flip side of that is if we rip up higher, it could turn into what's called a dead cat bounce, and we go into a prolonged correction and or bear market. I want to note that every single week this year, we have tagged the weekly expected move. This week was the second largest of the year, $11.26, and we are well outside of it as of right now. If we take a look, at VIX curve, this is what I find quite interesting that could potentially create that bear trap. First and foremost, the VIX curve, we're still in contango, which means basically everything is good. VIX is up here at about 19, like VIX futures about 19, and in looking out, we see it a little bit higher at about 19.6. Backwardation would look like this. It means that, hey, we got problems here right now. We're looking to get out of it later into the future. This is the March, the April, the May, and the June contracts. Now, while this is taking place, I like to look at back month versus front month volatility. And hello, intraday today, we did get below this 1%, but we still have room to go down here. We didn't quite close at the 1%, but we are at the 1.0 level here, but we are nearing that level, which is where in the past we have found bottoms and or periods of consolidation. You can see over here, right here in prior history. So you can see potential bounces and they can very well lead to dead cat bounces. For example, over here is pretty much right here. And we saw, I didn't draw that well, but we saw a pop up higher and then it started fading. That was in 2022. So we're kind of approaching these extended levels right now. If you look at something like growth versus value and you apply, this is actually the Q. So I have this relative strength line is the one that I'm measuring. I'm measuring the 10-week rate of change, the 10 period daily rate of change. And what you see here is the 10 period rate of change is actually kind of moving into an oversold condition. And you can see when we put the Qs up, when we have value outperforming growth by a pretty large percentage point, which is why this line goes down, you can see when we reach into these areas, we have found short-term, longer-term bottoms right over here too as well. So we're moving into kind of an extended area as it stands. Yesterday, we talked about the relative strength line between S&P 500 and TLT. So when this line goes down, especially at a fast rate, it tells us that there's somewhat of a flight to safety going on. And people are going into bonds, which are known to be more of a safe haven, or have historically been more of a safe haven. But what you'll see here is an RSI on this, and these sharp moves can get into oversold conditions. It doesn't necessarily mean a bottom has to be in, but if we look at the prior times that we gotten under 30, which we just did on today's trading session, this day we got well through it, but you can see we got here. And guess what? Why? Well, it's because there's somewhat of a flight to safety. Over here, it kind of marked a bottom. Over here, it marked a little short-term bottom. Over here where we saw some volatility, which doesn't look like it, but we did see some volatility. That found a little bit of a bottom there too as well. Another way you can look at this SPX to TLT relative strength line is this yellow line here. That's the same line. You see the line go down, but when this line makes a lower low, but in the same time, the S&P 500 actually has a higher low, it's actually led to market rallies. So take a look, right? So right here, we had the lower low, we had the higher low. What happened? It resolved to the upside. Right here, boom, we rallied to the upside. Right here, we rallied to the upside. Right here, we continued rallying more to the upside. And where are we right now? Well, we actually currently have a higher low in the S&P 500 by like nothing. So this could get crushed and then this will be ignored. But then we have a significantly lower low reading over here. So is this telling us something? Perhaps, right? We'll know in hindsight for sure, but this is what's currently taking place. Now, while this is going on, if we take a look at the percent of stocks above the 20-day moving average, there's still room for this to get more oversold, okay? So this kind of goes to the theory of the potential of a bear trap where we can flush even further than what we saw today, get more overextended, and then potentially start to see a bottoming process happen. And or the flip side could be just a dead cat bounce, which for those that don't know, you get a strong move to the downside. It rallies up higher, people get super excited, and then flushes, which is kind of what we saw in NVIDIA in recent trade. Okay, a couple other charts that still have room to potentially go to the downside. We got the BPCOMPQ. This is the NASDAQ Composite Bullish Percent Index. It is moving into this oversold condition, but we're not quite there yet. So this is probably going to slip into an oversold condition. That means we can potentially see a positive divergence form on this specific composite bullish percent index. If you look at the NYSE bullish percent index, we're moving into an oversold condition. I would like to see this slip a little bit lower to create a bullish divergence here too as well. If we take a look at the bullish percent for the S&P 500, take a look. This, after even this move, it's not even oversold yet, right? In terms of the RSI. I mean, here in 2025, earlier 2025, this little sell-off over here, that brought us down to a 40% reading, and we're still well above that. So some people might look at this and say, well, that's actually technically a bullish divergence if S&P 500 crosses lower. And to an extent, that's correct. I would still like to see this at an oversold condition. If we look at the bullish percent index for the S&P 100, okay, so this is zooming into the stocks that matter the most in the S&P 500. And take a look here. This thing is far from being oversold or overbought. And this thing has been going, what? Basically straight down these last few days. So this to me is pretty interesting. So how could this possibly be? Well, because other stocks in the S&P 100 have been holding up rather fine. We haven't seen any sort of capitulation yet. If we take a look at the old fool indicator, this has crossed over. I haven't got the updated one for tonight. It comes way later tonight, but it did cross over on yesterday's reading. And this this is a very laggy indicator, but sometimes it really does help to find larger trends, particularly to the upside. But you can see we had a buy signal over here. This is actually more of a whipsaw. Over here was a sell signal. This was the main buy signal over here. I didn't mark them on my screen, but we do have a sell signal here where the 21 period is crossing under the 50. Okay. And that's both EMAs on the relative strength line between NASDAQ Composite and the total put to call ratio. So when you see it over here, this was a sell signal. It sold off, right? Then we bounced And then we came off even further, and we got our big buy signal over here in November after it rallied. That led us to a nice rally. We had a sell signal and some whipsaws in here. You can see, and then it got more clear that we saw a buy signal. So this is starting to curl over. We'll see if it holds or goes into whipsaws here, but that is something to call out. If it's anything like the 2023 over here, this 10% correction, what can happen is that sells off, and then we see this sort of dead cat bounce and so forth. And if it is a correction that lasts a while, you can typically see sometimes 3 waves of selling before that kind of exhaustion takes place. Let's take a look at the current market conditions. So here we go. There's that 5,900 on SPX. We crashed through it today. We cracked right through it. We saw a little bounce intraday, came off. Have we filled the gap yet? Not entirely. We're still a little bit lower. So what would a bull trap look like? If we get some continued selling, start to pay attention to around this 5,800. And if price can turn back up, this can create exactly what we saw here, is how we broke out to the upside and we completely reverted, where we can flip to the downside and we could potentially move strongly back up to the upside. Now, if you want to be more tactical, you can step aside, wait for price action to confirm, because we're still below declining 5-day moving averages and year-to-date VWAPs across the SPY, the Q, IWM, semiconductors, biotech, and the DIA. So market conditions are still very bearish, right? It's bullish when the market proves itself, when we get above a 5-day moving average and it starts to incline, when we're in positive gamma, when we're not below the flip line, okay? If you want to see the flip line is over here at about 60-20 now, so we've broken from it. This is where, once again, selling begets selling, buying begets buying, and you get a lot of fake outs in both directions. Take a look at the expected moves going into tomorrow's trading session. Once again, we got some large expected moves. In fact, these are larger than yesterday's expected moves, which is crazy. The SPX has a $56 expected move just for tomorrow. The SPY, which we're looking at here, $5.93. We're outside of the weekly implied move, and this little gray line right over here is last year's closing price. Notice how we're below it. What does this mean? It means that the S&P 500 is currently down on the year. Oh my goodness. Over here on SPY, 582.17 can be that gap fill. And then we have targeting down here is actually, we have one more day left in the month, and this is the lower daily move, and it's in confluence with the month to date expected move. So if we break down here and we close or we bounce from here, whatever it is, this is all expected as of January 31st when we pulled these numbers. This was all trading within expectations. However, we're outside of the weekly move, so the week itself has been more volatile than currently expected. Let's take a look at the Qs as well. If you want these daily expected moves every day sent to you, they're in the Discord. I post them there, okay? But I like to share them here on occasion too. On the Discord, I'll give it for IWM, ES, NQ, Ruddy, and SPX as well. Here's the Qs. The Qs, you're looking at about a $7 expected move tomorrow, which today it went past its expected move. So it could do it again. We're in a very volatile environment. This was last year's closing price. Look at, we hung around there and then it started breaking from it. And this is the month to date expected move. So we're still above that. Tomorrow's day can bring us down to around 493 or up to around 507 to 508. We're well outside of the weekly implied move. So if we snap up, maybe we gap up and the market wants to get some relief, pay very close attention to that lower weekly move in the Qs. That's all I got for you on today's episode, everybody. We do have some macro data coming out. That's what's on deck, not much else. I'll see you on the next.